If you've been scrolling through YouTube lately, you've probably seen at least one video with a title screaming something like, "Do this before November or lose $2,400 in Social Security benefits." And if you're already collecting retirement benefits, or you're about to, that headline might have stopped you cold. After all, no one wants to lose money they've spent a lifetime earning. But let's take a breath, because while the warning sounds urgent, the truth is very different and far more important than the rumor itself. Yes, there are certain steps you should take before the end of the year to protect your Social Security income, and yes, there are mistakes that can cost you real money. But no, you're not about to wake up one morning in November and see $2,400 vanish from your benefits. In today's breakdown, I'll show you what's really behind this viral headline, what the so-called November rule actually means, and what real actions you can take before the year ends to lock in every dollar you deserve. We'll cut through the noise, expose the myths, and walk step by step through the essential Social Security updates for 2026 that most people still don't know about. So, if you're retired, planning to retire soon, or helping a loved one navigate the process, stay with me until the end, because in the next few minutes, you'll not only understand the truth behind that $2,400 rumor, but you'll walk away knowing exactly how to keep your benefits safe and growing. Let's start by unpacking where this viral panic even came from. A few weeks ago, a series of videos started circulating across YouTube and Facebook, claiming that anyone receiving Social Security had to contact the Social Security Administration before November 1st, or risk losing $2,400 in benefits. Some even said the government was changing the rules or cutting checks only to those who acted in time. Sounds serious, right? The problem is, none of it was true. These videos weren't official government updates. Many came from content farms overseas using artificial intelligence voices and faces to pump out dramatic titles and half-true claims. Their goal wasn't to inform you, it was to get clicks. They took a small grain of real Social Security policy, twisted it out of context, and turned it into a countdown clock that scared millions of retirees. Here's the truth. The so-called November 1st deadline was based on a misunderstanding of a legitimate Social Security rule, something called the 12-month withdrawal option. That rule allows someone who recently started collecting benefits to change their mind within 1 year and withdraw their application, as long as they repay the benefits they've already received. But it's not tied to a date on the calendar. It's not about November. It's about your own filing date. So if you started collecting benefits last November, then yes, you might have a decision window that ends around now. But if you started in February or June or October, your 1-year mark is completely different. There's no nationwide cutoff, no government memo, and no $2,400 being automatically taken from anyone. Unfortunately, when false claims spread online, they cause real harm. People start calling Social Security offices in panic, flooding phone lines that are already understaffed. Others rush to make changes they don't need, or worse, make decisions that hurt them long term. So before you believe a headline that says act now or lose everything, take a moment to verify where it's coming from. The real story here isn't about a sudden deadline. It's about understanding how and when you can change your Social Security filing to your advantage. And that's exactly what we'll unpack next. Now that we've cleared up the rumor, let's talk about the real Social Security rule that started all this confusion and how it can actually work in your favor if you understand it correctly. When you first apply for Social Security retirement benefits, you're making a long-term decision. Your benefit amount is locked in based on your age, your earnings record, and the month you decide to start collecting. But what if, after a few months, you realize you filed too early? Maybe you found a new job, your financial situation changed, or you simply learned that waiting could increase your monthly check. That's where the 12-month withdrawal rule comes in. This rule gives you a one-time opportunity, and within 1 year of your initial claim, to withdraw your application and essentially hit the reset button. When you do this, it's as if your original filing never happened. You repay the benefits you've already received, and later, when you're ready, you can reapply at a higher rate. Why higher? Because every month you delay your benefits beyond your full retirement age, you earn something called delayed retirement credits, which can increase your monthly payment by as much as 8% per year for life. Let's make that real. Suppose you started collecting Social Security at age 63 and your benefit came to $1,800 a month. Then a few months later, you got a part-time job and realized you didn't actually need the income yet. You could use the 12-month rule to withdraw your claim, repay what you've received so far, and wait until 66 or 67 to restart. By doing that, your monthly benefit could rise to around $2,100 or more every single month for the rest of your life. Now, this isn't for everyone. Not everyone can afford to repay what they've already received, and you can only do this once in your lifetime. But for those who acted too quickly, or for those who got scared into filing by a misleading headline, it's a valuable option that gives you a second chance. So, if you filed within the last year and you're reconsidering, this might be your window. But remember, it's your personal 12-month window, not some blanket national deadline. There's no November rule. There's just your own timeline and the choice to use it wisely. And while we're on the subject of real, actionable Social Security changes, let's move into the updates for 2026 that actually do affect your benefits and your paycheck. Here's where things get practical and where real money is on the line. Every year, Social Security adjusts several key numbers that determine how much you can earn, how much you pay into the system, and how much you're allowed to make if you start benefits early. These updates don't make flashy headlines, but they matter far more than any viral rumor. First, let's talk about the earnings limit, one of the most misunderstood rules in the entire Social Security system. If you start collecting benefits before reaching your full retirement age, there's a limit on how much you can earn from work without reducing your payments. In 2025, that limit is $23,400. But in 2026, it's rising slightly to $24,480. That means if you make more than that amount in a year, Social Security will temporarily hold back $1 in benefits for every $2 you earn over the limit. Let's say you started collecting early and your benefit is $2,000 per month. You earn $10,000 over the limit. Social Security will withhold $5,000 worth of benefits, which usually means suspending your first few monthly checks until they've recovered that amount. But here's the part most people miss. You don't actually lose that money forever. Once you reach your full retirement age, Social Security recalculates your benefits to credit you for the months that were withheld. In other words, you eventually get that value back through slightly higher checks going forward. It's a delay, not a penalty. Now, if you're still working and earning well above the taxable maximum, here's another number that's changing. The Social Security wage base, which is the maximum income subject to FICA taxes, is increasing from $176,100 to $184,500 in 2026. That means higher earners will pay Social Security tax on about $8,000 more of their income next year. There's also the full retirement age limit, the higher earnings threshold that applies in the months before you reach your full retirement age. That's going up too, from about $62,160 to roughly $65,160 for 2026. During that special year when you're about to hit your FRA, the reduction formula becomes a bit more forgiving. Social Security withholds $1 for every $3 you earn over that limit, instead of the 1-for-2 rule that applies earlier. Now, what about the delayed retirement credits I mentioned earlier? These are still one of the best-kept secrets for boosting your lifetime income. For every year you delay taking benefits beyond your full retirement age, you earn an additional 8%. So, waiting from age 67 to 70 adds roughly a 24% increase to your monthly check. And that increase is permanent. If you're already collecting benefits, but you're not yet at full retirement age, there's even something called a voluntary suspension, which lets you pause your checks to start earning those same credits. It's not well known, and many Social Security representatives may not mention it unless you ask, but it's a legitimate, often overlooked strategy to increase your benefit in the long run. So, as we move into 2026, the takeaway is this: forget the viral fear mongering and focus on the numbers that actually impact your wallet. Understand your earnings limits, know your thresholds, and remember that temporary withholdings aren't lost. They're recalculated later to give you back what's rightfully yours. Now that you know the real updates for 2026, let's talk about what you should actually do before the year ends to protect your benefits. Because while there's no magic November deadline, there are small, practical actions that make a big difference in what you receive next year and beyond. The first and most important step is to check your earnings record. This is something many retirees forget to do. Yet it's one of the most powerful ways to protect your future income. Your Social Security benefit is calculated using your highest 35 years of earnings. If one of those years is missing or recorded incorrectly, it's like losing a full deposit in your lifetime account, and that can permanently reduce your monthly check. Go to ssa.gov, our My Account, and create a My Social Security account if you haven't already. Once you log in, scroll through your earnings record and look carefully for gaps or 0 years. If you notice a missing year, say you worked in 1985 but it shows nothing, that's a red flag. Sometimes employers make small mistakes with Social Security numbers, and your income ends up in what's called a suspense file. The good news? It's usually easy to fix. Contact the Social Security Administration, provide your W-2 or tax documents for that year, and they can correct it. Fixing even one missing year can mean hundreds of dollars more every month for the rest of your life. The next step is to plan your filing timeline wisely. Many people don't realize that you can file for benefits about 3 to 4 months before you actually want them to start. This is crucial because Social Security payments are always paid a month behind. For example, your October benefit arrives in November. If you wait until the last minute to apply, you might face a gap of 1 or 2 months with no income simply because of processing delays. And if you're calling late in the year and the office says they can't schedule an appointment until January, don't panic. You can still protect your filing date by doing what's called a protective filing. Simply call or contact the Social Security office before the end of the month and tell them you intend to file. That conversation locks in your eligibility month, even if your appointment happens later. So, if you call on October 31st and your appointment isn't until January, Social Security will still treat your claim as if it started in October. Finally, if you're still working while collecting benefits, make sure you know which earnings test applies to you. Stay under the monthly limit if you're using the monthly test, or plan your income to stay below the annual limit if you're filing for the full year. These rules can be confusing, but the key is simple: plan ahead, report accurately, and never assume you make too much to apply. The monthly test can still make you eligible even after a high-earning year. In short, your to-do list for this season is simple but powerful. Check your earnings record, file early enough, confirm your limits, and lock in your protective filing if needed. These small steps can save you from unnecessary delays, missing credits, or lost months of benefits. The people who stay proactive don't just avoid problems, they maximize every dollar they've earned. Now let's switch gears for a moment, because even though Social Security and Medicare are closely connected, the rules for each can trip you up in different ways. And for 2026, there are a few Medicare mistakes you'll definitely want to avoid. If you're already receiving Social Security benefits when you turn 65, Medicare enrollment usually happens automatically. You'll get your Medicare Part A, hospital insurance, and Part B, medical insurance cards in the mail about 3 months before your 65th birthday. But here's the part that often confuses people. If you're still working and covered by your employer's health plan or your spouse's plan, you may not need to enroll in Part B right away. In fact, doing so could cost you unnecessary premiums. The rule is this: if your employer has 20 or more employees, you can delay Part B without penalty as long as you remain covered under that group plan. But if you work for a small company, fewer than 20 employees, You'll need to enroll in Part B when you turn 65, even if you still have coverage, because Medicare becomes your primary insurance. Now, here's where a lot of retirees get into trouble. If you delay enrolling in Part B when you were supposed to, Medicare will hit you with a 10% penalty for every 12 months you went without coverage, and that penalty lasts for life. The same goes for Part D prescription plans, where skipping coverage can trigger late enrollment fees that never go away. So what should you do if you're retiring later, say at 70 or 75, and you've had employer coverage the whole time? In that case, you'll qualify for what's called a special enrollment period, which lets you sign up for Medicare Part B without any penalty once you stop working. You'll just need two simple forms: the CMS L564, which your employer fills out to confirm your coverage, and the CMS 40B, which is your official enrollment form. Once you submit those, Medicare will start your coverage right away, penalty-free. It's also important to remember that Medicare's enrollment windows are strict. You have a 7-month window surrounding your 65th birthday, 3 months before, the month of, and 3 months after. If you miss that window and you're not covered by an employer plan, you'll have to wait for the general enrollment period between January and March, and your coverage won't begin until July. That means months without coverage and possibly higher premiums. And one last point: the Medicare Part B premium changes almost every year. In 2026, it's expected to hover around the mid-180 range per month. If that feels heavy, check whether you qualify for your state's Medicare Savings Program. This program can help lower-income seniors by covering some or even all of their Part B premiums, and in some cases, it can reduce out-of-pocket costs too. So before 2026 arrives, take an hour to review your Medicare status. Make sure your coverage aligns with your work situation, confirm your enrollment timing, and avoid unnecessary penalties that can eat into your Social Security check. You worked too hard to lose your benefits to a technicality, and with just a little planning, you can make sure every part of your retirement coverage works exactly as it should. Before we close, there's one more thing we need to talk about, and honestly, it might be the most important part of all. Because no matter how well you plan or how early you file, one of the biggest threats to retirees today isn't paperwork or penalties. It's misinformation. Every single week, new videos pop up online promising secret payments, urgent deadlines, or once-in-a-lifetime loopholes that the government doesn't want you to know about. And at first glance, they sound believable. Slick thumbnails, convincing voices, even AI-generated hosts that look professional. But when you look closer, most of them share one thing in common: they're vague, fear-based, and they never link to any official source. So how do you protect yourself and your peace of mind from this flood of false information? The best way is to remember 3 simple questions. First, does this information come from an official U.S. source? Anything dealing with benefits, Medicare, or federal programs should trace back to ssa.gov or medicare.gov. If it doesn't, it's not official. Second, does it sound urgent or too good to be true? Real government updates are rarely announced through dramatic YouTube countdowns. If someone's using panic to grab your attention, it's probably not about helping you. It's about getting your click. And third, does the person explaining it actually give you details or just broad claims? Real information includes numbers, forms, timelines, and context. Fake news gives you emotion without substance. Here's the truth: Social Security isn't some secret maze you can hack. It's a set of clear rules. Complicated, yes, but public, transparent, and accessible to everyone. The goal isn't to chase viral claims, it's to understand your situation, your earnings, and your options. So, if you see another video claiming you'll lose thousands unless you act immediately, pause. Check the source. Visit ssa.gov, read the update for yourself, or talk to a certified Social Security advisor. When in doubt, verify. Because in today's world, the smartest move you can make is to protect your attention as carefully as your money. And remember this: every time you ignore a false claim or share accurate information with a friend, You're not just helping yourself, you're protecting an entire community of seniors who deserve clarity, not confusion. So, let's bring it all together. No, you're not going to lose $2,400 if you don't call Social Security before November. That viral claim is fiction. But what is true is that your retirement security depends on what you do between now and the end of the year. Take a moment today to log into your My Social Security account and double-check your earnings record. Make sure there are no missing years or errors that could shortchange your benefits. If you're planning to retire soon, don't wait until the last minute. Schedule your filing appointment or start your application 3 to 4 months before you want your payments to begin. If you've recently started benefits and had second thoughts, look into the 12-month withdrawal option. It might give you a valuable chance to reset and increase your lifetime income. And if you're already collecting but still working, review your earnings limits and make sure you're staying within the right thresholds. Next, review your Medicare situation. Are you turning 65 soon? Are you still working? Do you know whether your employer coverage qualifies? Catching these details early can save you from lifelong penalties and unnecessary costs. Finally, make it a habit to question what you hear online. The internet is full of noise, but the truth is always simple. Your Social Security benefits are yours. You earned them through years of work, and the system exists to pay you fairly, not to trick you out of your money. So instead of reacting to viral fear, focus on verified facts. Plan your filing date, review your earnings, understand your Medicare coverage, and stay informed. Those are the real actions that protect your income, not some imaginary November deadline. You've worked for decades to build security for your retirement. Don't let misinformation or small mistakes take that away. Take a few minutes today to check your records, confirm your coverage, and make sure your benefits are exactly where they should be. Because peace of mind in retirement doesn't come from rumors. It comes from knowledge, action, and knowing you've done everything right to protect what's yours.